Firms cannot obtain a higher price by lowering its output. Firm does not need to lower its price to sell more output. Average revenue is total revenue divided by quantity equals price. Total revenue equals price times quantity. Margin revenue is change in total revenue divided by change in quantity. So in this case, if you did margin revenue, taking the change in total revenue, it would be a flat curve. So margin revenue is calculated by taking the difference between total revenue from one price to another. So perfectly competitive firms are price takers, so they cannot maximize profit by changing the price. They can maximize its profit, minimize its loss only by adjusting output. So in this case, they would, in this case, where do you think they would maximize profit? What total product would they have to produce to maximize profit? What total product do they have to produce to maximize profit? Okay, that's okay. So 9. So they have to produce, they have to have total products of 9 to get maximized profit. So yeah, here would be the maximum economic profit right here. So this is the biggest difference between total cost and total revenue. This green line is the biggest difference between total cost and total revenue. MR equals MC rule. Firm produces the last unit of output for which MR is greater than MC. Only implies that MR is greater than ABC. It is P equals MC under perfect competition. So yeah, this is like I showed before, this is where they maximize profits, where total product is 9. It's right here. So they maximize profits, they maximize profits where MR equals MC. So that's always true. If you want to maximize profits, you set MR equal MC. Suppose the market price is $81 rather than $131. Still produced because price is greater than the minimum average variable cost. So they want to always cover variable costs. So short run, they want to cover variable costs. They are fine to take a loss if they are covering variable costs. But long run, they will shut down if they are not making a profit. So short run, they could make a loss could make a loss for a while as long as they are covering variable costs. So they don't have to cover fixed costs in the short run. So in this case, total product is 6, and this is where profit is maximized. So you have marginal cost almost equal to marginal revenue. So if marginal revenue equals marginal cost, profit is maximized. And here it shows that profit is highest at MR equals MC. So make sure MR equals MC to maximize profits. So firm will not produce at prices below its minimum average variable cost. Quantity supplied increases as price increases. Economic profit is higher at higher prices. The price equals marginal cost rule is the key. A wage increase shifts the supply curve upward and to the left, decreasing in supply. Technological progress will shift the supply curve downward to the right, increasing in supply. So should this firm produce? Yes, if price is greater than or equal to minimum average total cost. This means that the firm is profitable or that its losses are less than its fixed costs. What quantity should the firm produce? Produce where MR equals MC there, profit is maximized or loss is minimized. Will production result in economic profits? Yes, if price is greater than average total cost. So for firms facing losses due to fixed costs, shutting down in the short run does not mean shutting down forever. Important question for firms with fixed costs: will producing output make the hole even deeper? Low price can be temporary. Some firms switch production on and off depending on the market price. Examples: oil producers, for resorts, and firms that shut down during recession. So that's a good way. If you're making a loss right now, you could shut down. So like if you are losing money, you could shut down for a while and start back up when you know you will make a profit.